All right. Good afternoon, everyone. I'm Bobby Argitis, Senior Investment Specialist here at National Bank Direct Brokerage. I'll be your host today, and I've got my colleague, Mr. Pierre Laroche, Managing Director of Business Strategy at National Bank Financial Markets. Today, obviously, our webinar will be on what is an option, the third part, and we'll be talking about some of some of the more basic or more advanced option strategies. Obviously, a heads up, we'll be giving if there's any quotes that are used, any companies that are used. These are obviously just examples. Obviously, you need to do your own research. But the goal of using actual securities is to make the examples a little more believable. For those of you who attended our two previous webinars, we talked about what is an option, what is a call, what is a put, different ways of using them. Then there was the second one, which is a little more on the price of the premium, which I'll let Pierre do a explanation. And this one here is some of the basic option strategies. Some of them you might be already aware of. There's four of them, and we decided to use to have some for basically basic strategies that everyone can use. Some of them a little more. One will be a little more, a little more involved, and the last one is more for those of us who are a little more expert. Anyway, without further ado, I will now give off the space to Pierre Laroche, who will commence the presentation. Pierre, go ahead. It's all yours.
Okay, thanks, Bobby. Hello, everyone. I'm happy to be here again with you. I hope that you had a good weekend, and we're going to start this third part of our webinar. And as Bobby said, the two previous ones, were more the first one of the fundamentals, like definitions and basic profit and loss graphs, the functions, of options, calls, and puts. After that, the webinar number 2, we really focused on options pricing. How can we value options, and what are the factors that impact option prices, okay? And then we made a distinction between the intrinsic and time value of an option. The intrinsic value, remember, is like if you exercise the option, would you realize a profit or not? So when you realize a profit, when the option is called in the money, we also said that term, there is a positive intrinsic value, and the time value adds up to the intrinsic value to give the total value of the option. So we focused on the time value of the option because the time decay, is an important factor to take into account when you do like basic option strategy, like buying a call or selling a call, buying a put or selling a put. And we saw that, the time decay is very slow, at the beginning, but as maturity approaches, it gains steam in the sense that you lose a lot of the time value towards the last segment, while we are approaching the maturity date. So this is an important concept, that we try to well explain, previously. And also we took notice of implied volatility, which is like, what is the volatility such that the formula, the result of a pricing formula is equal to the observed price, of the option. And the implied volatility tells us about how cheap or not, an option might be. We talk about the VIX. VIX is a volatility index, which is a lot looked upon, by professional and serious investors. And we said that to be successful in trading options, you have to have a good view on the underlying asset, the underlying stocks. Once again, today we will focus, just as Bobby said, to give realistic example on options on stocks, a stock option. But you can have options on other underlying assets, and so when to be successful in your options trading, you have to have a good view, so good forecast, on the direction of the price of the underlying asset, but as well take into account around the implied volatility. If it is very high, it has a tendency, to revert to a mean of, in the case of stock options, like 18-20% per year. This is the volatility, it's a standard deviation. And if it is low, if the implied volatility is low, as today, I didn't see the opening, but yesterday, the implied volatility for the S&P 500, the VIX index closed under 12.5%, which is like rather low. This means that, you don't pay a lot for the time value of an option. So it's the other factor. So having a good view on the underlying asset price direction is important, to successfully trade an option and also to have an opinion on the implied volatility. Is it high or low, and how should I position, my options book to take into account, not only the current price of the underlying, but also the current level of volatility. We will get back to that. So today, as Bobby said, we are going to cover four a bit more advanced options uses. Some of you might already be familiar with some of them, some may not. And so first we'll start with protective puts. After that, we'll go with long straddles, covered call writing, and cashed secured put writing. And we'll explain that with a realistic example, actually an example that dates 2 weeks ago. So, okay, we already said, the first pane of this page, and now essentially these options, these more advanced option strategies, they might have like 3 different goals. One of them may be protecting, your portfolio's value, or, a single investment that you have on a single stock, you can protect that value against a market downturn. Also, you can combine options, to benefit, from specific events, but with unknown outcomes. So we can combine calls and puts. So we'll see one way to combine calls and puts and in a realistic setting. And then you can use options, especially selling options, call or puts, to add to investment revenues. And we'll see 2 ways how to achieve this. So what is interesting with options, it adds, a lot in your traders, active traders toolbox, because you can do things with options that you cannot do if you only have access to the underlying asset by itself. Okay, so let's get going. So most of today's example will focus on Moderna shares, and we take, the Moderna shares on the NASDAQ, so the U.S. market. Why we take the U.S. market? Because it's much more liquid, so the bid-ask spreads are thinner, and so when you do active trading, suppose you go in and out options, liquidity is an important factor, and the U.S. market is much more liquid than any other market in the world, including the Canadian market. Some Canadian options are pretty liquid, but most of the time, you'll find more liquidity on the U.S. market. So we'll take Moderna as an example, and this example dates 2 weeks ago, so as at May 14, 2024. And so Moderna at the time was trading at about $129. And so and so we'll use that case, for the coming examples. So let's start with the protective puts. So you could be, in one of the following situations, right? You want downside protection, against an expected decline in the price of a security you already know, so you own. So for instance, you already own 100 shares of Moderna, but you fear that, earnings announcement that are about to come, let's say in a month from now, you fear that they won't be as good as market expects. You know that Moderna had a very good run over the last few months because people expect, some of their product pipeline to start, generating profit. And so that Moderna no longer only relies, on the COVID shots, to generate growth. And so, but you may think, oh my God, I'm not sure. And you just want to protect, this investment in 100 shares of Moderna. So also and the second point is much more similar to the other. And so you you have like an unrealized gain in a non-registered account. So, protecting that gain, may be something. So it's really a way, right, to hedge the downside risk, to protect against a downside of markets. And so you simply, in this case, you're still long, the shares, but on top of that, you buy a put. Okay, so and this is what we call, a protective put. And so if the shares price drop, then the puts profit will compensate totally or partially, depending on when that drop happens. Okay, so again, so let's we know that the Moderna shares currently trade at about $129. So suppose that you have a view over the following month. So let's on May 31st. So there are options traded on the CBOE, Chicago Board of Options Exchange, so that mature on May 31st with the strike price of 120. So you can consider these May 31st 120 put that you could buy on May 14, for about $2 net of fees, right? So this is what this would look like. Okay, so first of all, pay attention to the green line, So the green line is that in this example, we assume that you bought, the shares at 120. So you bought the shares at 120, and the goal is to protect that initial investment, the invested capital. So the green line, okay, is the profit of Moderna shares. So if the shares go up, of course, you do a profit. If they go below 120, you will lose, and it really doesn't matter when you did this acquisition, when you purchased these Moderna shares. So the only thing that is pertinent is how much you paid for it. In this example, we assume 120, and you want to protect your investment, and this is why we choose, a put option with $120 exercise price. And so of course you have to pay for that, right? We saw that when you own an option, you have to pay for this option, in this case, to sell Moderna shares. And so the other line, this is a broken line I want you to focus on, is really the black one, the profit function of the long May 31st 120 put. So this is like, so if the options expire above 120, you will not exercise the option to sell it, because, if you want to sell these shares, you simply will sell them, at the current market price. So this is why above 120, you see a flat line. You see a flat line that means that you will have paid the $2, quote unquote, not for nothing, but you will not exercise the option. So you don't get back, the $2 you paid for that put option. However, on the other side, if the price of Moderna shares drop, the earnings announcement is really not good and worse than, people thought, materially worse. And so of course, the shares may drop below 120. In this case, you will want to exercise, your put. You will want to exercise the right, to sell the Moderna shares at 120. and so that you protect, the initial investment in that security. So this is like the black. This is the black broken line. I just want to put your attention that what is the result, of being long the underlying asset and long a put. So when you add, these two lines, the green line and the black line, or maybe blue, dark blue line, right? You obtain, the result of the protective put is shown in the violet line. It's the violet line. And what does it look like? Some of you probably already may have noticed that, being long the underlying asset and long a put option, the result is it's the same as being long a call. So by which you limit your loss and the stock goes down, and you gain, if the stock goes up. And so, and you remember we rapidly alluded to the put call parity in the last seminar, in the last webinar, sorry, where we said that to value a put, we just value the call and apply, the put call parity. And we didn't have much time, to see exactly what this put call parity consisted in. Now we have a good illustration of it. Long the underlying, long the put, gives roughly, roughly the same thing as being long a call with the same strike price and maturity. This is the, the result of the protective put. It really looks like being long a call. So I thought that, this mention, could be of some interest to some of you. And you see, so that you see that option prices called put, on a given underlying asset for a different strike price, they have to be coherent, right? You cannot have, an option, a put option price that is completely disconnected from the call price, because that long the put option, long the underlying asset, is equivalent, to being long the call. And so if there is a big discrepancy, make sure that, be sure that arbitrageurs, hedge funds and some banks, will jump in, just to correct this discrepancy. So take for granted, that all the bid-ask prices you see on, the NBDB website, that come from the exchanges are prices, bid-ask prices for puts and calls that take into account that if there is a discrepancy, there will be institutional investors will put on arbitrage opportunities just to get the prices back in line. This is what is very interesting with options. You don't have to figure out, is the option overvalued or undervalued, right? Because of this possibility to arbitrage calls and puts and the underlying asset, you have a very good coherence in options, call and put prices. Okay, great. Another very interesting strategy in a completely different framework is a long straddle, okay, being long a straddle. So, and the context is the following. So that a big event is coming, right? And that big event will have a major impact, on the stock. But you don't know that what way. Once again, the earnings announcements may be a good example that that there is going to be an announcement, a project have been evolving for that company, and then you see, you think that either it's going to be a big surprise up, in which case the price of the underlying asset will go up materially, or it's going to be a very disappointing announcement, and so the stock price will drop, the underlying asset price will drop, but you don't know. You have no views on that. You're not sure, and you want to put in place, an option strategy just to make sure that whatever the impact of the announcement, positive or negative, that whatever the sign, the direction of the impact, you're good. You will make a profit. So in this case, you can buy a call and buy a put, near parity, so meaning that near the current price of the underlying asset, okay? And by doing so, you will be able to benefit, either way, as we will see. Okay, and this is what we call a long straddle. You buy a call and you buy a put, both of them near parity, meaning that the strike price is near, the current underlying asset price. It doesn't need to be at the cent near, right? At the $1 or $2 near, let's say 1-2%, of the underlying asset price is good enough. You close enough. And then, by putting that, you buy the call, you buy the put, and then you wait for the news to come, and then if it goes in one direction, one leg of that long straddle will be profitable. You simply sell the other one. Of course, you will lose on the other one, but if it is a big impact, the gain on the good leg, will largely and multiple times compensate the loss on the losing leg, and vice versa. If it goes down, the put leg will gain and the call leg will lose, but you will be good enough. So in this case, and here the scale of the graph may not be optimal. Sorry for the mouse. I was distracted. So let's say that roughly speaking, you could buy a call or a put and a put, for about $20. It's not cheap, but what is interesting, you have in place a position, where by buying, the put, if the news is negative, for instance, then you will benefit from that. And if the announcement is positive, much better earnings than forecasted, then the consensus, will benefit. So of course, at maturity, the break-even in this case are respectively, because remember that the Moderna shares as at May 14 traded at about $129, so near the $130 strike price that is illustrated here in that graph, so that it may seem to be a very wide range, right? But remember that even if the stock goes from 130 to 120, it doesn't, the put, will gain value and the call will lose value. The call will lose less value, and so you will still have like a profit. So this is like the illustration of the profit at maturity. But if the maturity is further away from the announcement, we just want to illustrate here that whatever is the direction of the impact, you will be okay with that strategy. So this is one strategy you may want to consider for like as I said, earnings announcements, some elections. So as you know, sometimes the option market will react to elections, right? So because if a party wins, and you really don't know, it's a close race between, let's say, two parties, and one of them is very, let's say, is in favor of one measure that is favorable to businesses, and the other one is, on contrary, wants to, let's say, raise taxes on corporate earnings, so depending what party wins, the election, it will influence, the stock market, in one direction up or the other direction down, depending on which party wins. So often, you will see professional traders put in place, straddles, long straddles surrounding election announcements, especially if it's a very close race. If it's not a close race, right, that that Party A is going to crush, all other parties added together. Of course, this information, the very likely election, of Party A, is already priced in. It's already included in the underlying asset price and the option prices. And it, in this case, putting in place a long straddle may not be pertinent. But when the result is really, really uncertain, then it's a position that you should consider seriously. And even, if it's not regarding firm specific factors like earnings. It might be like in general, announcement of the discount rate, of the central bank, is a macro factor that will impact prices, So when, let's say that the Fed will have its next meeting, I guess, on June 7, the coming June 7, in about 1 week from now, a bit more. And so that this announcement, people expect the Fed to at least, to stay at the same level or to lower, its prime rate. But if, on contrary, it goes up, because they consider that inflation is not tamed enough, then of course you'll see market go down. But if, on contrary, they lower the rate, while the consensus is that they should stay there, then the price will go up. So the coming, Fed announcement could be a good event around which investors could to look at putting in place a straddle just to benefit from the outcome, whatever it is, of that Fed decision. Good.
Yeah. Yeah, maybe if I could just jump in for a moment. Very, excellent examples. I think I remember in the past, mining companies waiting to get a permit approval, right? That could be a catalyst for the stock price again to go up or down. Pharmaceutical companies, will their drug, pass the stage 3 approval, right? So there's many different scenarios that are available. I just wanted to mention to the people who are listening. So long straddles and the protective puts, those fall under those strategies. Since really you're buying a put or buying a call on the put, they're considered, I guess, in level 1 strategy, in the sense that they can be done in any type of brokerage account. So again, it could be a cash account, could be a TFSA, an RSP. And for those of you who are wondering, well, am I able to do this type of transaction? It's very straightforward. If you're an NBDB client, log into your brokerage account and then click on the buy or sell button. And when the trade ticket appears, if you see a heading for options, then essentially you're good. You'd be able to do these types of transactions. And I'll just let Pierre move on to the next one. I'll have a little more information for that one as well a little bit later.
Go ahead, good point. Good point, Bobby. Yes, indeed. Implementing more advanced option strategy may require from your part, to make sure that the type of account you opened is valid. Okay, covered call writing now. So one way, and it's a very popular option strategy, is that you already own, the underlying asset, let's say 100 shares of Moderna, same situation than the first example we gave today. And then, and you may have specific views, on the underlying asset, or you may think it will remain there. The price won't move much. So if you writing a call, remember, it's like selling a call. Writing a call, writing a put, selling a call, selling a put. It's the same thing. Writing is just another way to designate, the fact that you sell, So by selling the call option, you cash in the call option premium, right? And which adds to your investment revenue. On top of that, right, if, you bought, the Moderna share, as we gave as an example earlier, at 120, they are now at 129, and you think that your target price is, let's say, $140. So that if, the Moderna shares jump, to $140, right? Then you would have sold them. So you can simply stay there and wait for the price rise happen. It gets to 140, you get rid of the Moderna shares. But the other, what options allow you to do, you can write a call with the 140 exercise price. And by doing so, okay, you will cash in, the call premium. And so this will add to your investment revenue. And if the price goes up, then eventually, the buyer of the call will exercise the option, and you will have to sell, the underlying shares at 140. But this was your target price or your target sell price anyway. So, you can, so you will be happy anyway, and you already own the shares, so the delivery of the shares won't be a problem, right? And so it is interesting for the if, for the scenario that the underlying price, the price of the underlying asset, goes up and reaches your target sell price, you can do so automatically by selling a call option. And if the price goes down, well, the fact that you cashed in, the premium, the call premium, diminishes your loss. So, it's for those of you, who own, bunches of 100 shares, because remember, on most North American options exchanges, one option, has 100 shares of underlying assets. So if you have 100 shares of Moderna, this could be the covered call writing strategy, can be something that you will be interested in. So this is what I just explained, right? If the call matures out of the money, so worthless, you simply, the buyer won't, exercise the option, you keep the premium and you're happy. And if the call, if the underlying asset goes up and the call rather matures in the money, so that the underlying stock price is higher than the strike price, then the buyer will exercise the option. You will have to, to sell them at 140 in this previous example I gave. And so, but you're okay, because anyway, you would have sold the Moderna shares at 140 because you reached the investment, it reached the investment objective you have. So in this case, so let's take, exactly this May 31st, 140 call, which was, so when you write, calls, you sell them at the bid price of 189. So these are prices that were, available on May 14, and so the result goes as follows. So once again, start by putting your attention on the green line. This is the profit on the Moderna shares. Remember that we assume that you bought them for $120, and then you sell, a call with a strike price of 140. So this is at the bottom, the blue broken line. So you cash in, let's say, 180 net of fees, from selling or writing these calls. And then, as if the underlying asset price or Moderna share price, matures, or is above 140 when the call matures, then, of course, you're obliged to sell at 140, and your break-even price is 141.80, so it's 140 plus the 180. So you see that, you do realize your profit, but by doing so, you cap your profit, at 140, but you are richer by $1.08, so $1.80 per share, so $180 for 100 shares, which is not bad, given that the maturity is like 2 weeks away. So you simply add to your investment revenues, which is like not it's material, right? You pay the lunch, you pay the Friday evening lunch with that, and so, or dinner, right? And so this is something very interesting. It is probably the most popular option strategy with those who do own some shares, and want to add to their investment revenues. And we have very disciplined, sell prices, so they know that at which price they want to sell, in this case, in this example, 140. So it's interesting. Bobby, I don't know if this requires a special type of account, though.
Thanks, Pierre. In terms of accounts, it's actually available in all types of accounts as well. It's just the investor needs to be authorized to write covered calls. Again, for that one there, I would suggest for those of you who are already National Bank Direct Brokerage clients, you can reach out to us through our secure messaging center and just ask them, am I authorized for covered call writing? Honestly, it's usually within the same day they'll respond. If it's a yes, then you can go ahead. If not, they'll tell you how to make the request to have your account coded. But again, it's available in all types of accounts. So again, RSP, TFSA, RESP, you name it. Pierre, actually, got a question. Concerning to roll over the covered call, they're asking is like, when is the last day you can do it? I imagine it would be on the expiration date before the market's closed. That'd be like the latest you'd be allowed.
Yeah, exactly. So, but remember that you want to do this. Those who consider this, so it's called covered call writing. Good point, Bobby, that you raised. First of all, because it assumes that you already own the underlying asset. You already own the underlying 100 Moderna shares you paid $120 for, right? First of all. So then when you want to put in place, the covered call writing strategy, you know at which price you would like to sell the underlying asset, in this example $140. So of course you can do that last minute, okay? And you know that if you do this last minute, the time decay would be very steep, right? And so if you sell at a certain price, the call, it will lose value, which is good for you. You sell at a higher price, and as time passes by, it is in your advantage, at your advantage. However, if you do this like just a few days before maturity, the premium will be very thin. Even there may be some, especially in the Canadian market, market makers may even not quote, anything, on that. So you want to have a higher premium. Remember, the further away, is the maturity, the more time value an option has. So the more money you will cash in by selling the call. So those who want, to use this strategy to grow, materially grow, their investment income, should not consider like options. Well, should not. It's not a recommendation. Usually, the people don't do this because they want to cash in a juicier premium. So they will sell calls, maturing more than a few days away. But still, let's say 1 month away, something like this, 2 weeks away, so that you cash in more money. So because the time value of the option you sell is higher. But still, since we are within 1 month from maturity, you will benefit from, the time decay. And so this is another factor you want to take into account. So good question.
Pierre, I got a second question. I think it's relevant for this example also. In the case where let's say Moderna had decided to do a share split, a stock split.
Yeah, interesting.
So your one contract. I guess what happens?
Usually, it may differ from one exchange to the other. I don't know the rules for all exchanges, but most of the time, what you have is that you simply so everything is the strike price is divided. Let's say it's a 2-for-1 split, right? So the strike price will be divided by 2, but you will own options on 200 shares. So so you divide so the option now is not on 100 share, would be on 200 shares, but with the strike price at, in our example, $70. Most of the time, this is the adjustment that exchanges do for ongoing options. If there's a split, that happens, while the options are traded. This is the most common adjustment. So you don't lose. You don't lose whatsoever, if that event, corporate event occurs. Good. Okay. So let's move on, to the to our last very interesting strategy is the cash secured put writing. And again, Bobby, perhaps disclosure for the type of accounts for that strategy is granted.
Yeah, for this particular strategy, a margin account is certainly required. I don't know if you can see it on your screen, but under the notes at the bottom, we mentioned it's very clear. You'll see, well, as Pierre explains this particular strategy, that in the scenario where, let's say, you don't have the assets for it. That's why a margin account would be required. So again, it's can only be done in a margin account. So it's not for every type of investor, but maybe it could be something that could interest for those of you who have a margin account. So I'll let Pierre continue with this example.
Okay, good. So this strategy is particularly interesting for the type of stock market we have recently. Stocks have been experiencing a good ride, right? Recently, over the last few months, year to date, I think the S&P is up more than 10%, and which is good, right? And people, and especially investors, are pricing stocks, and all other securities, pricing in, the future drops, of interest rate by the Fed. And also we know that the Bank of Canada will follow suit. But, there's always the risk of many analysts think that the underpriced risk right now is that, the inflation will stick in. It may even tick up, so that, the Fed, it's not excluded that the Fed may decide to raise interest rates, right? Just to make sure that we tame inflation once for all. And if this happens, because the current stock price already incorporate, anticipation of interest rate declines, then you can have, if this doesn't happen, and if on contrary the Fed rises interest rate, the stock indices could lose a lot. But you know that this is like just a temporary adjustment, of expectations, and you may want to benefit from that. So, for instance, you may consider that, the shares, of Moderna or any other company it's a good company, but you think that they're fairly priced, or perhaps a bit even overpriced if you are more of the bearish side of investors, but you see that if the price drops to a certain level, then I may be interested to buy some. So there are two ways to do this. So you think that you like a company, you think it's a bit expensive, and you wait for something to happen, a Fed rate increase, or a negative announcement, from the company, the price goes down to your target buy price. So there are two ways, to get, to buy the stock at that buy price, the target buy price you have in mind. You can simply give a buy limit order. You call your brokers, the MBDB, right? And you say, if the price drops to a certain level, I want to buy 100 or 200, whatever the amount is. So this is one way to go. But another way to go is to sell a put with a strike price corresponding to your target buy price. Because remember, right, the sellers of a put, or the put writers, if, the put becomes in the money at or before maturity, then the put buyer can exercise, the right to sell. If, the buyer of the put can exercise, has the option to exercise, the option to sell, then the put writer is obliged to buy them at the strike price. So in this case, you're fine, because you set, the strike price exactly at the point which was your entry point. This is like the strike price corresponds to the price at which you would have bought the shares anyway, right? And so between these two possibilities, simply give a buy limit order or write a put, you'll have the same result. You'll buy the share at your target price. The difference is that by writing puts, you cash in the premium. So then, for the same result, you get some revenues for this. And this is right now, one strategy that in the current, let's say, macro financial context where we really don't know, when, the Fed will start lowering the rates, and there, the risk of of the Fed doing the other way around, rising the rate, is still material. And so this is one strategy that is usually interesting in that type of context, right? And so our same thing for regarding earnings announcements, right? So if there's a bad earning announcements, the price of the underlying asset tanks, right? It goes down, it reaches your target point, then you can, that you can buy these shares at the strike price. So let's take, the example again of Moderna, and this in both cases it assumes that you already have the required cash to buy 100 shares. It is the case for you have to have that cash. This is what we call this cash secured put writing. So you have to have that cash ready to be deployed. If you write a put, but it's the same thing if you give a buy limit order, right? If you give a buy limit order, you have to have some cash available, to when, the price goes down and reaches your limit buy order, then you have to have the cash, right? So it's the same thing. It's the limit order case or the writing a put case, it assumes that you already have the cash ready to be deployed if the stock price of Moderna goes down, to your target level. So in this example, I take 114, right? So you can write if, this is like a point. So suppose in this case, you don't own Moderna shares. So in the previous examples, we assume that you already own, except for the straddle, but for the protective put and the covered call writing, it assumes they already own Moderna shares. Now, in this case, you don't own them yet. You just want the price to go down to 140. And at this point, you consider this is a bargain, this is a good price, and then you want to buy 100 shares. So if you write May 31st, 114 puts, you would have received about 80 cents per share. This is the price at which you were traded on May 14, 2024, receiving, nearly $1, 80 cents per share, while the share price, is about 120 for 2 weeks, is material, right? It's not nothing, right? It's a good addition, to your investment revenue, and so it is an interesting strategy. So in this case, if you do this, right, you sell, you sell the put, you cash in the 80 cents per share. So for one put, 100 share, it's $80. You keep these $80 as long, as the underlying asset matures above 114. So, for instance, the current Moderna price is at 129. So if it goes down, if it is above 114, you keep the premium because the buyer won't exercise the option to sell at 114 if he or she can sell above 114 on the market. And if, the announcement or whatever, the earnings announcement, or as Bobby said, the clinical trial results announcement, are not good and the price tank below 114, then you will buy, the buyer will exercise his or her option. And so you will have to buy them at 114, which is your target purchase price. But by the way, on top of that, you will have received the 80 cents so that, the net cost of acquiring these Moderna shares is not 114. It would be 113 and 20 cents. So you will save 20 more cents, 80 more cents, on, the purchase price. So the net cost would be 113 113.20 cents rather than 114. So very interesting strategy. If you have, a particular view on shares you don't own, and you have an entry point below the current point, in this case, you think that if Moderna goes down by about 10%, which would bring them at about 114, let's say 10-12%, then you would jump in. So if it is the case, if you have any such view, on the share, on shares you want to consider buying, but wait that the price goes down, you should, consider that kind of strategy. Once again, we don't advertise Moderna. We give it as a academic or educational example. You can have your own view on any share, and as long as there are puts traded on these shares, right, you could consider that strategy, as a way to enter, to buy, the shares. I don't know if there are questions on that one.
Pierre, I was actually looking at one of the questions, and this one's a little bit, well, I think it falls outside of it, but for tax purposes, the premium obtained when doing covered calls or doing cash secured puts, how are they treated? And I guess the
capital gains. It's capital gains. I do that, I would say, regularly, and I can tell you that my accountant is very specific about it. The only thing that ticks, and that won't make your accountant happy, is when you sell options, let's say somewhere in December, but the maturity is later on, let's say January or February, right? And then so you sell something, let's say in year 2024, but as at December 31st, unless you buy them back, these options, you still own them. But so you received money, you receive a revenue, but there's no cost. There's no cost to the option. You didn't buy it back, or you were not exercised, right? And so this will make your accountant smile. So it is. But once they are used to this, it will be like an easy way. There is a solution, but if you do this and it's the first time that your tax accountant sees that. He will probably, or she will, scratch her head, for the first time. After that, but it's capital gains, definitely.
And obviously,
sorry, Bobby, to interrupt. Unless you do that so often that you do that regularly, on many shares, then it could be considered as a revenue. So tax higher. It's like flipping homes, right? At one point, the tax people can consider you flip homes so often that we have to tax you as if it was a business revenue. Same thing for writing options. It depends on the intensity, the amounts, the frequency of such trades. If you do it too often, the capital gain status could be questioned.
So I guess ultimately again, if you do it, once in a while, it should generally be considered capital gain. If you're very good at it or do it very often, the CRA might change their opinion of it. Obviously, if you're doing this in a tax sheltered account, there's nothing to declare. Obviously. Pierre, before moving on to the next topic, and again, I'll leave it to you if you want to answer it. There's one talking about the trade-off between, let's say, writing, I don't know, a 6-month covered call, or doing, let's say, 2-3-month covered calls.
Interesting. There's a lot about the time decay, right? So that the shorter maturity, the option is, the more rapidly you will lose a time value. So if you write options, calls or puts, the time value, the decay will play in your favor, right? More rapidly for shorter dated options. But if you roll 2 times, 3 months options rather than 1 month option, you'll have less money, right? In the sense that if you write a 6 month call or put, the premium will be higher. So it is like the same kind of question, very good question, by the way, that bond investors ask themselves. If I want to invest for a 2-year horizon, I retire in 2 years, I want to buy, I don't know, an RV, and should I roll 2 times a 1-year certificate of deposit or take a 2-year certificate of deposit? So it depends on market conditions, so when you sell your first option, your first 3-month option, you know exactly what you have as market conditions, but you don't know how much you will pay the second one, the second 3-month options, right? So this is like an uncertainty, that may be good or not, so you have to ask yourself, right? So there's no textbook answers. There's no one unique solution for that problem. It really depends on, it is a good decision depending on market conditions in 3 months from now. Suppose that you want to sell options and then, the volatility is lower in 3 months, then you have less. So it really depends, and it's a good segue, for the next topics on what is the current level of volatility. If the implied volatility of the option or the general implied volatility of the market is very high currently, well, selling a 6-month option may be advisable. Once again, it's an academic example. It's not a trade recommendation, but because currently the implied volatility is high, we already saw that the implied volatility has the tendency when it spikes up, to revert to some sort of a long-term average for stock indices, 18-20%. For individual stocks, it's the same thing. It reverses to the more long-term average of the implied volatility. Then, so if, you want to take that decision at the point where you just had an implied volatility spike, perhaps selling for 6 months is more advisable, because the probability that in 3 months the volatility will still be as high, so generating as more investment revenue is small. There's a small probability that this happened, because we know that volatility spikes revert to a lower mean relatively rapidly. So, but on contrary, if the implied volatility is very low, then perhaps you want to buy, a 3-month, expecting that you want to sell, a 3-month option, call or put, and in 3 months you expect volatility to be higher, and in that case, you will receive more investment revenue. You'll take more risk because volatility is higher, but you receive more revenues. So a very good point, a very, very good point. It relates to the fact, to the allusion we made at the beginning of this webinar, and what I was just about to say, that your strategy, and this is a very good example, thanks again, should depend not only on your views on the underlying asset price, but also when you want to take a decision or buying or selling a call, short term or longer term, it really depends on your view on implied volatility. So I don't know if there are other questions. We still have a few minutes.
Actually, go ahead, Pierre. I think we got the major ones, so plow through.
Super. So this is the same graph that I showed. The red line should be lower, nearer to 20. I don't know what happened. There was a shift in the cut and paste, I guess. So this is, an example that when you have spikes, in this case the VIX, but it's the same thing for the implied volatility of individual options or options on individual stocks, that it reverts back, and you can see here that the long-term average over the last few years, in this case about 4 years, but even in a longer range, over a 20-25 years, considering that the long-term stock index volatility is about 18-20%, and you take that as a gauge, of the general volatility of markets, is a good guess, usually a good guess. Then once again, it's not a simple recipe. It may change. It's just a general rules that usually is good to take into account. It's not 100% sure. I don't want to sell you recipes. There's no recipes on markets. It's a risk to return, right? Game, as you know. And then, your decision to buy a to sell a short-dated option versus and roll it with another short-dated option rather than selling a longer-dated option really depends on where the volatility currently stands, when you have to take this decision. Sorry. So then it's 1:00 already. So we just saw 4 strategies. We only had an hour today. There are hundreds, of different strategies. There are very good books on how to use options, for different situations. But we saw like some of the most popular ones today, the more advanced strategies, protective puts, by which, you just protect, the value of shares you already own, against, an eventual drop. Let's say following an earnings announcement, you fear that the earnings announcement won't be good, and so you want to protect your investment. Long straddle, you don't own the underlying asset, but you want to benefit, from a news, and you don't know if the news will be positive or negative, right? And so this is a good way, to benefit, from a major news of an unknown impact, positive or negative. Covered call writing is interesting. In this case, the term covered assumes that you already own the shares. So you own the shares and you write a call to add to your investment revenue. And most of the time, people, that do this strategy will choose, the strike price at which they would sell. This is like the target sell price, right? So so suppose that the target sell price is 10% or 20% above the price they paid, they just select the strike price accordingly, and they cash in, the call premium. And anyway, if they are exercised, they would have sold the underlying shares anyway at that price. So meanwhile, rather than receiving nothing, they receive, you cashed in, the call premium. And the cash secured put writing is a bit like some sort of the same thing, but it's like a buying opportunity, right? So that you don't have the shares for the cash secured put writing. You have money set aside. You have a view on a share, and 100 shares, and you wait, for the price to go down at a certain level to jump in, right? To buy the shares. One way to do that is to place, a limit order buy, buy a limit buy order at a certain price. Let's say 10% below the current price. But another way, is to write a put with a strike price 10% below the current price, and then you will have the same result. You will be able to buy, the underlying shares at the price you have in mind, and meanwhile you cash in, the put option premium. So it's a way, right, to make time work for you. Selling calls and puts. So, and also we spoke again about implied volatility, the very good example, of one auditor, asking us, should we go for longer dated options or roll shorter dated options? It really depends on largely depends on where implied volatility stands at the moment to take this decision. We hope that these webinars, this last webinar of a series of 3 was helpful for you, and that it will help you to get good or better, in your options trading, and that it will contribute to successful, options investments and trading. And we thank you very much for your attention. So we're done, and so take care and happy options trading.
Excellent. Pierre, thank you very much for all the work you put in, for building these presentations, all 3 of them, the time you put in. It's I certainly could not have been able to have created this, so I really do appreciate having you host, work with me on these events. If I could ask one last comment, if we're looking for those of you who have the bug now or interested in perhaps trying covered call writing or cash secured puts, one of the tools that we've spoken about in the previous presentations is called Options Play, and that tool can help you choose the strike price, choose the date, and within that tool, there's a section where you can specify your time frame, whether it's short term, long term, whether you're more conservative or more aggressive with your search. So just to give you a heads up, best option is to go on YouTube and then type in National Bank Direct Brokerage to access our YouTube channel. And once on the page, you would go to the section called Enrich Your Experience as a Do-It-Yourself Investor. And the second video that appears in that section is called Covered Call Writing with Options Play. Within that section, there's also a mention for cash secured puts. It's a nice introduction, and you'll get an idea. Obviously, for those of you who are already clients of ours, if you decide to play around with the tool, what type of premiums you can receive. I'm just going to check one last thing to see if there's any other questions. Okay, someone's asking about the cash secured put and the TFSA. No, it can only be done in a margin account. And I think that's about it for the questions. So thank you very much, everyone, again. Pierre, thank you again as well.
It has been a pleasure. Goodbye, everyone.
Everyone, have a good day. Bye.
Goodbye.